So we have ETF within Insurance Solution. Bruce Morris, CEO, TAB Group. It's all yours.
Great, thanks. And thanks for the prior two panels, because I think they set up our conversation just perfectly. So my name is Bruce Morris. I'm the CEO of the TAB Group, for those of you who I haven't had the pleasure of meeting. I'm going to let my group introduce themselves, and then we're going to jump into the conversation.
Hi, Del Campbell with Lincoln.
Turn it on. Turn it on.
Figure this out. Del Campbell with Lincoln Financial, manage the variable annuity product and investments for Lincoln.
Hi, Toby Crowder. I work at First Trust. I've been at First Trust just a little over 15 years, and the majority of my time I've been spending in the insurance space. And then since roughly the summer of 2017, we started getting into the insurance solutions, which covered customized index offerings, both in the RILA and the fixed indexed annuity space.
Good afternoon, Jason Uberti from Capital Group American Funds. I've been with the firm for about 8 years and came to the firm from Prudential's annuity business. I lead our insurance product development efforts at Capital Group.
Good morning, everybody. Jason Orlowski. I co-run the wealth management proposition at Gallagher. In my role, I'm the chief investment officer as well as head of platform, and especially as we talk about today, we look at both balanced portfolios, but being a part of a large insurance company, obviously insurance, annuities, and things like that fit very much into the conversations we have on a daily basis.
Great, thanks. So the way we plan on utilizing our 50 minutes here, we broke the conversation down into three primary categories. So first we're going to talk about market trends, then we're going to talk about product construction, and then we're going to finish up with distribution. So the first question, and I'm going to kind of break this up with the panelists. So Jason O. and Del, market trends are favorable for annuity sales, an aging demographic, demand for principal protected strategies. How much longer do you see these tailwinds lasting, and are there any headwinds that are going to be facing the market too?
I can start, and I'll talk about two specific product lines. One, variable annuity with living benefits, as well as the RILA market, so more of the structured market. Both of them have, I would say, strong tailwinds. I would say the variable annuity with living benefit is a little bit more like flatline growth, so kind of more moderate growth. Now, what has helped that over the last 6 months, and I think will continue at least over the next year, in terms of advisors using living benefits for their clients, is the fact that rates being high like this, both absolute rates as well as swap rates. That high swap rate allows the annuity companies with living benefits to provide very, very high income guarantees. So those looking for lifetime income can now get roughly a 6+% income guarantee and still have 80% equity exposure, which is very strong. So I think those are some tailwinds for the living benefit business. A big headwind for the living benefit business, though, is expenses. You know, we in the insurance industry have made these products pretty expensive right now, and that's certainly going to be a tailwind. I would imagine there's going to be continued fee pressure from advisors on these products. The other headwind that I will mention is, quite frankly, the RILA market. We offer both product lines, but we've seen a lot of advisors shift to the RILA market, the structured annuity payouts, because they are simpler, quite a bit more transparent. So we've seen some shift to that. So we try to keep a balanced mix of both, but those are a couple headwinds and tailwinds for living benefits. On the RILA market, I think the opportunity is very, very strong there. A lot of strong tailwinds there are, we're seeing more and more entrants into the market. A lot of what we heard the last couple hours around defined outcome funds and ETFs is really helping RILA market, because it's providing education on those structured payouts. They have the structured note world and the defined outcome world reach a very, very broad advisor base relative to annuities. So bringing those stories of structured products to advisors is certainly a a tailwind for the RILA side. I do think that the tailwind or the headwinds for the RILA market, quite frankly, right now a lot of us are very, very heavily concentrated into S&P type options, so we look very, very similar. I think part of what we're trying to do is which tails into this conference, is to partner with some of these ETF providers to actually add differentiation and provide the advisors what they're buying in the retail world. Okay, now you can buy that with protection, and I think that's a strong tailwind.
Great. Jason, you want to?
Yeah, well, and I'm coming at it more from the practitioner's standpoint. As I talk with my advisors and clients, I mean, really what we see, there's actually a growing demand. There's plenty of tailwinds today, but they're getting stronger, especially with where interest rates are going now. I mean, we've had so many clients that just want to sit in cash. They're getting 5-6% doing that. That's becoming less and less of a possibility, especially as the Fed cuts more. And it's getting to a point where, what do I do with this cash? I'd love getting this consistent level of return. Well, guess what? We have a whole series of products that are designed to mimic something similar to what you've experienced for the past couple of years. And I think that starts to build a little bit of momentum. Looking just broadly speaking, the amount of cash the Fed has successfully pulled out of the system in their interest rate hiking cycle, I mean, you're talking on the order of a couple $1 trillion that's been pulled out that now needs to go back in. So what does that mean for this marketplace specifically? Well, this is a great alternative. This is a great place to be. And I think as we get to sort of more the point of the panel, adding ETFs within these, it's creating it. Initially, annuities felt more like a black box. You know, what is this? How is it pricing? How is it coming together? Indices coming into it, great. I understand the S&P, but some of these other ones, maybe a little bit more vague. Adding ETFs, there's even more familiarity. So you're at this interesting nexus where investors have a lot of cash. They've been happy with sort of this consistent 5-6% level of return that they're not going to get anymore. And they want something that has a good amount of protection and good level of consistency. And you know, that's squarely where this market sits.
Great, thanks. So let's talk about ETFs in the annuity space. And Jason, you want to lead us off with that? What role do you see ETFs playing in the annuity space?
That's a great question. And I actually think ETFs are going to play an increasing role within the insurance space. You know, they're broadly adopted in client portfolios. Institutionals like the structure for the flexibility they provide. So there's no question insurance will definitely increase adoption and usage there. In February 2022, Capital Group entered the market with a suite of ETFs. They're fully transparent, active, managed strategies that leverage our investment capabilities that have been around for a long time. And this is kind of a really huge deal for our insurance business as we seek to broaden our participation in the market. And we're excited to explore these options with insurers. You know, Del and I launched earlier this year ETF RILA strategies that are based on 2 of our active ETFs, and it's pretty cool stuff.
Toby, you want to add to that?
Yeah, what I would say, just as you look at the evolution of not only the ETF marketplace, but from the insurance perspective in the insurance space, you know, ETFs 25 years, give or take. We really entered this space, as I said in my opening, in the summer of 2017, when we started talking about, you know, the potential growth and in the RILA marketplace. So the registered index-linked annuity marketplace and then the fixed indexed annuity marketplace. The way I like to break it down is the RILA is registered, security-based, and then the FIA world is more non-registered and more state insurance-based. But with regard to those, you know, you've seen significant growth. I look at, I think the calendar year 2017, there was roughly around, I think, $7 or $8 billion total in RILA business. You look at last year, it was approaching $50 billion, and now I think through the first half of this year, it was at $30+ billion. So you've seen a significant amount of growth in the RILA space. You've seen a similar amount of growth in the FIA space, where it's basically doubled over that same time frame. With that being said, as Del had mentioned, the predominant strategies or the predominant investment options that you saw in this space was associated with the S&P. Obviously, the large other indexes serve a purpose also, whether you're looking at Russell, whether you're looking at EFA, whether you're looking at an emerging market, whether you're looking at the NASDAQ 100, et cetera. But with, I think, most recently, I think the 21st entrant in the insurance space or in the insurance distribution space entering the market this fall with a few others entering either at the end of this year or the start of next year, these options and these strategies are clearly becoming more commonplace. With that being said, a lot of the companies look similar with what they offer, but what you're seeing is customized solutions in this space. When we entered the space in May of 2018 with our Capital Strength Index with Lincoln, in our partnership with Lincoln, quite frankly, the ETF option, our ETF FTCS, was relatively small in the marketplace. So from a liquidity standpoint, it really wasn't a viable option to use as an underlying ETF in the RILA market. You fast forward, 6.5 going on 7 years from now, and you've seen growth in this marketplace. You've seen customized indexes in this space. That now you have the liquidity, you've got the differentiating features, whether it's the payoff profiles, the tenors, all of these different aspects, where you're now starting to utilize ETFs as an option. Obviously with Jason entering, one of the solutions that we launched in May is a combination of 50% into one underlying index, 50% into the other underlying index. With that being said, the primary hedge providers that are actually providing either the cap and buffer solution to this or the principal protection are now looking at using ETFs as a hedging instrument in this, and I think it's going to just continue in these platforms where you're seeing ETFs as a solution, whether it's rules-based or it's active in the RILA space and the FIA space also.
Thanks. So let's now start to drill down into the weeds and talk about product construction. And I'm going to stay with Jason and Toby on this question. So traditional ETFs are rules-based index strategies. Does the use of ETFs blur the lines with fixed income annuities? And is that a good thing or a bad thing?
Yeah, so notwithstanding the last panel talking about defined outcome ETFs, traditional passive ETFs versus fixed indexed annuities, I see a lot of daylight between the two. So not really concerned about blurring the lines there. I actually think, when it comes to annuity sales, annuity purchases, you've got investors who are seeking certainty, they're seeking guarantees, they're seeking protection. And so, there's a difference between the two. I also think, there's a future for active ETFs and a proliferation of these types of strategies in index structures. So you can take a portion of a client's portfolio and protect it in an annuity structure. So it's the same strategy that they have in their portfolio, but a protected version of it through an ETF index within an FIA.
And what I would also say is just you're seeing a lot of, for lack of a better term, growth in both phases. I like to look at the fixed indexed annuity space as more, you've got a lot of vol control solutions in this space. I think if you take out all of the S&P type options, so the S&P strategies, like right now in the FIA space, I think there's roughly, and again, as a marketplace evolves, I think there's roughly about 160 different offerings in this space that are non-S&P related. With that being said, in the RILA space, the registered space, you're looking at more in the 30 or 35 offerings phase. So you're starting to see growth. You're starting to see growth in the non-S&P related structures, and then again in the payoff profiles, whether you're looking at certain, the predominant payoff profiles. I think in the RILA space, you look at it, the FIA space is more, you're focusing on more of, an outcome period of, point to point 1 year or point to point 2 years. In the RILA space, you're looking at longer tenured vehicles. So you're looking at, like, the majority of our assets that we have that are currently domiciled in this space is more in the, in the 5 and the 6 year tenured space. But with that being said, as a compliment to Jason, and the offering, you are seeing growth in the shorter tenured offerings. With the shorter tenured offerings, my interpretation is a lot of the rules-based or the quant strategies that we have in this space, you're now seeing the prevalence of active management. More than likely, the active management strategies are probably going to be more difficult to hedge on the longer tenured version than the shorter tenured version. But again, as I said, the active space, from a hedging perspective, is allowing for the short tenured business cycle to quite frankly grow. So I think it's, as you get more offerings, you get growth in this space, you're starting to see more sales in this space.
Thanks. So Jason O. and Dell, so how do ETFs allow for more customizable annuity solutions? And as you're bringing those answers, can you provide some examples of tailored strategies that utilize ETFs? And if you could throw into the mix, I know this is kind of long here, but talk about principal and downside protection and option strategies that are being implemented.
Sure, I'll start off with this. I think for us, especially where it is, our challenge is to take something great that's created by the industry and bring it down to the average investor and sort of make those connections. And we had this problem as we've all talked about this evolution where you've got structured product as sort of the base of where you saw it in high net worth. It's gone into the annuity space with different type of indices, now with ETFs. I think the challenge we've always come across is, how do you describe an index to the average client that's not one that's plastered on CNBC? The constant question is, what the heck is this thing? What's nice is, being industry professionals, we have access to all sorts of tools, all sorts of different indices that's at our fingertips. But again, our clients don't have that. So again, we're stuck in that black box kind of world, and just say, look, historically, everyone can run a hypothetical analysis. Here's what it looks like. It's going to be, it's the solution that fits what your goals are. It fits your objectives. And the clients generally have to take that at face value. Well, now bringing ETFs in, there's something they can actually look at themselves too. They can see what's going on. They can even go independently if they want. We're in an age where people love to do their own research and love to put all those pieces together. It makes it more approachable. And I think that's at least for us, what one of our problems has been is let's forget annuities for a second and just say generally index-based investment solutions. So everything from a structured product all the way down to the RILAs that can be super sophisticated, complex, hit exactly what we need. It's that underlying index is the problem. And it's convincing the client, here's why it fits and meets your objective, and it's not one of the three that's on the screen when you look at CNBC. And that's what's interesting about bringing ETFs into this space and being able to bridge that gap, is we're now able to start pointing to, well, here's exactly what it is that we're going to put in there. Here's what's going into that product. And then as we start talking about, okay, there's a cap, there's a buffer, this is to help sort of reduce that volatility. It starts building out that picture better. I think the last bit that we have is again, you've had the volatility over the past couple of years. We just got through a bear market. The last time we had a bear market, absent the pandemic, because that was really short, has been years and years. So clients remember volatility. They're scared about that. So now you can even say, well, let's look at how this ETF performed over that time. Let's talk about what those buffers and caps do. Let's talk about how all that comes together. And now I'm packaging it into an insurance product so that you're set up for a period of time. This is really meeting those goals and objectives. You don't have to worry about where we are. So that's really what's been helpful for us, at least. I'd say probably the amount of annuity solutions that we're putting within portfolios has probably grown. Not probably, it has grown dramatically over the past couple of years. I think because of that familiarity, because folks are starting to understand more of what we're putting in and what we're doing. Unfortunately, it's still more, it is that S&P, it is sort of those familiar pieces that people see, but we're starting to have at the fringes talking about whether it's sort of split between a couple different ETFs or a couple other different solutions. And it's creating that familiarity, that connection that's transitioning from a good conversation to actually implementation in client portfolios.
I would add, from a RILA standpoint, adding active ETFs and active strategies has been a game changer for us from a perspective of getting people to look at these. And in terms of the opportunity in the ETF world, when you look at when we look at active strategies, there's a couple things we need to look at, right? We need to make sure that the banks, whether it be Morgan Stanley, any of the banks, need to be able to hedge these. To Toby's point, it's a lot. They feel a lot better hedging them for 1 year, maybe 2 years, versus going out 4, 5, and 6 years, because active management, you have they're buying options or they're buying that ETF, and a lot can change on some ETFs. So when we look at these ETFs, these active ETFs, both with First Trust and Capital Group, we looked at ones that were not built for the insurance industry. These were built well before we offered RILAs, and with First Trust, Capital Strength have been around for over 10 years. With Capital Group, the ETFs we chose, they weren't ETFs, but they were open-end funds that were around for 25, 30 years. And that gave the banks huge confidence in terms of being able to hedge these, and for us to get good pricing. So that's allowed us to offer active strategies. And part of the positioning from the opportunity on these is clients are buying these in the retail world. So it's a very easy pivot for an advisor. Hey, you're buying this already. What if we were to give it to you with some protection on it? And that's a huge value proposition to the client. In terms of some of the payout strategies that you referenced, Bruce, what these are giving us the ability to do is to create very innovative payout strategies on ETF. We can do it on S&P too, but everybody does it on S&P. But we've created some very unique ETF-based kind of strategies within our RILA product that allows for payouts in down markets. So whether the market is up or down, you get even the market's down 10, 15%, you can still get a positive 10% payoff. That's extremely positive from a client to hear about these types of strategies. The other thing that we're doing is that we heard about on the last panel where the constant management of the defined outcome funds, there's strategies around, okay, do I sell it and roll it into a new one? Do I buy the quarterly one? Well, we're starting to do that now on the RILA side, and we are doing it with active strategies where I can, let's say I've got a one year tenure, 6 months into it, it's up. I want to lock that in, and I want to just continue for the next 6 months. Well, you can do that now, and you can do it on S&P as well. But again, that's available. What's not available in the retail world right now is to be able to do that on some of these active strategies, and that's a huge positive for the RILA market and ETFs.
Thanks. All right, so moving into our third discussion topic here is the distribution side of things. I'm going to send this over to Jason O. and Toby. How should insurers educate their financial advisor distribution channel and retail clients about the benefits and risks of ETFs in annuities? And what are some of the key points they need to emphasize?
So what I would, the way I would frame this is through our partnerships that we have, specifically with Dell and our partners at Lincoln so the strategies and the product offerings that they have from an insurance solution standpoint, and I'll just speak specifically from a RILA aspect, their wholesaling force and their sales force is able to get out and interact directly with the retail advisors and the financial advisors, the planners, the RIAs, et cetera, on the actual insurance aspect of the products. The great thing is in partnership that we have between Lincoln and First Trust, our sales force, is very specific to the products that we offer. We offer a unit investment trust solution, in the retail space. We offer an ETF solution in the retail space, and on some accounts we offer a structured note solution in this space. The great thing about the offering that we have with our partner at Lincoln is with the Capital Strength Index, our sales folks not only have the understanding and speak about the methodology of that specific offering from a retail perspective, they also speak about it from an insurance perspective. So again, talking about a simplified story, a simplified methodology, whether it's a UIT, whether it's an ETF, whether it's a structured note, or whether it's as an investment option inside the RILA, it's made for our sales force to be able to communicate out into the marketplace a very unified and equalized front from a strategy standpoint. Would you like this tax deferred? Would you like it taxable? Would you like it in a, in a specific structured note scenario, or would you like it as an ETF or a UIT offering? We can offer everything from that standpoint, speaking about it with one kind of unified methodology. So it's been great to partner up with our friends at Lincoln and do this and provide multi-solutions from this aspect.
Yeah, from our standpoint, a lot of it is around advisor education. And I think it's, you sort of have two groups. You have the group that always does annuities. It's always a part of where they are. That they've stayed up on everything. It's they've gone from the traditional VA into the FIAs, and they've spent the time, they've learned, they've seen how that works. They're curious. They're starting to implement RILAs and using those. And then you've got the broader set. Occasionally they use annuities. Maybe they still think of it as just the VAs that were out there and that's it. And there's even education that needs to be done on the FIA side. But we spend a lot of time with our advisors educating, actually similar to what Del said here, of, look, if the clients already own the ETF, they're already used to having that. Well, there's other ways to package it and structure it in a way that gives more of that, let's use terms from the other couple sessions, defined outcome, more of those buffers, more of those patterns there that help to meet your goals and objectives. So we actually spend a lot of time with education. At the end of the day, these are more sold than being bought, at least from our perspective. And what that comes down to is that's education. Why does it fit? How does it fit? It is a little more complicated than the ETF. And that's where a lot of our focus has been with our advisors is, where are the situations where these come into play? They're great in the pre-retiree and retiree space. They do solve a lot of that uncertainty or even that anxiety as you're getting to that big milestone in your life. If you're about to retire, I can't take the volatility I had before because, well, heck, my income's not coming in anymore. And it's those education points we're providing to advisors and then helping to just issue spot. Where does it fit within portfolios and specific client situations? So I'd say on the distribution side, just speaking as a practitioner to the other distributors that are here, I mean, the more of that you can provide to us of when does this fit? Where are these the right solutions? How does this all come together? That just makes a better partnership and better implementation of the innovation that's taking place in the space.
Thanks. So Jason, you and Del, can you share some of the best practices that you see for both insurers and ETF folks that they need to employ in order to help distribution performance? Jason, yeah?
Yeah, I think Toby mentioned it earlier, and there's a simplicity element here that goes along with this work. ETFs and some of the simpler fixed annuities, they're elegantly simple products. They're easy to sell, they're easy to understand. The insurance industry has had trouble with simplicity. Variable annuities can be very complicated, and so we have a tendency to love complicated stuff. So we have to kind of check ourselves along this journey and make sure that we're keeping it simple so that we can effectively explain to our clients, our advisors, and so that they can explain it to their customers what's happening, how these products work. I think that's what we can do.
I would agree 100% with everyone who just talked about distribution here. Like, just because we can do something doesn't mean we should do something. And even when it comes down to looking at which types of ETFs to put in our product, the world's littered with great investment stories that don't have any money in them because they were not distributed right? There was no distribution behind them. I think on the previous panel they were talking about funds that are closing. Well, a lot of that is, it might have been a great strategy, but if nobody can convey that strategy to an advisor and also help them convey that to their client, it's going to die. So one of the things that we looked at, so when we look at active strategies or any strategy, we look at the distribution as an equal part of that decision. We need to have partners who have a proven track record of distribution, who can bring not only the distribution to people that we may not talk to, advisors that we may not talk to, but also who can partner. We've got a very large distribution force. So when we looked at First Trust and Capital Group, they partner with our wholesalers to make our wholesalers better. Our wholesalers are not right now, they're not investment wholesalers, they're annuity wholesalers. Yes, they have some investment background, they can talk about investments, but when it comes to some of these active strategies, we look for ETF providers that can partner with our wholesalers to make them better at telling the investment story. And when you have our wholesalers and Capital Group and First Trust out there all together, it makes the whole solution much more powerful than any of us individually.
Great. So this is the last question for us, and then we'll open it up to the audience if you guys want to ask our panelists. But this is I love it. It's the crystal ball question. So we'll just go down the row, and we'll start with Jason O on the end. So what do you see in the future? You know where we're at now. A lot of new developments, but as you look out a couple of years down the road, and you can talk about product construction. You can talk about distribution. Go for it.
Yeah, again, from our vantage point, I think there's more adoption. As I sort of said throughout, I mean, the challenge has been understanding what you're actually buying, what's going into your portfolio. And I think ETFs, while relatively new from a product standpoint, they're definitely seasoned. Investors know them and can look at them and understand them. And I think bringing them into different insurance solutions just makes it more approachable. As the other Jason has said, the insurance industry loves complicated. And how do you make things simpler? Well, one thing that you can do to make it simpler is use things that everybody knows. So taking that ETF, that solution you're used to owning, and well, guess what? You've owned it for the past, call it 5-10 years. And now you're hitting your retirement cycle, and you like the position, but you don't like the volatility. Well, here's a way to solve for it. And I think as those conversations become more commonplace, you're going to see a lot more of this happen. And I wouldn't be surprised if you see more of the shift towards ETFs, probably more in the RILAs, given the longer term, given the way they're structured. But it's going to become more commonplace and less of a one-off conversation and more of a regular, hey, here's where you are in your life cycle, your investment cycle. Here's the product that will help, not the complete solution, but help to enhance what your existing portfolio is.
Yeah, so I'll take it a couple ways here. So for variable annuities, I think there's an opportunity to build insurance series funds using underlying ETFs, fund-to-fund strategies. That could ease the complications associated with hedging living benefits. And so we see an opportunity there, certainly with our ETF platform, that's in many cases, for many of our solutions, are based on well-known retail American funds. So we see an opportunity there. We definitely see growth in fixed indexed annuities and the utilization of FIAs there. There is some talk around potentially allowing ETFs in variable insurance products that's years off. We don't really have a view on whether that's a viable approach or structure yet, but that's something that I just acknowledge is out there that we're starting to just think about.
Just to add to that, when I look at the potential evolution, I mean, clearly what we've seen over the last 6 years is significant growth, and then more importantly, significant growth with the underlying strategies in these products. But I'm very confident that when you look at the number of players in this space, and from an insurance aspect, you look at, again, I like to say you've got to have a simplified approach to this and making things easy to understand, whether it's an insurance-based product on the RILA front or whether it's a principally protected product on the FIA side. A lot of the strategies right now in the RILA space, even including the S&P, are priced in a price return vehicle standpoint. As you get evolution of actively managed strategies like Jason here to my left, and other potential rules-based strategies, again, as the marketplace grows, and again, when you get the hedge providers that get more comfortable and the liquidity becomes more prevalent, I think that you're going to continue to see all kinds of solutions, especially from an ETF aspect in this space. And every marketplace or every insurance distributor out there is looking for a way to differentiate their product. And by differentiating, it can be either an underlying strategy, an ETF, whether it's rules-based or active, or from the other aspect of differing either tenors or payoff profiles. And by doing that, once you can get it embraced by the hedge providers, it's going to only continue to grow. And the growth that we've seen over the last 6 years will grow, will continue to have growth going forward.
I want to talk about a couple things quickly. I think I haven't talked a lot about the fixed index annuity world. I know it's been mentioned up here, and it is that the indexes there that are vol-based are complicated. They're excess return, they're vol-based. They've disappointed people, I think, advisors and clients. What I would like to see and what I would hope that we can see in the near future is instead of using the indices in those FIA products, is maybe there's an ETF out there that has a strong, reasonably, low volatile type payout structure that an ETF could be used instead of a vol control index. That adds transparency, it adds immediate adoption, because I think advisors will embrace something that we've talked about that is already selling in the retail world. I would love to see innovation there. I'm hoping that we can figure something out in the next year or two on that. And then on the variable business, on annuities, most of us in the variable annuity, we have some type of mechanism to control risk. Usually we limit the amount of equity you can have to maybe 80%, which is still a lot, and the rest needs to go into bonds. Bonds in annuities are difficult. Bonds, even in today's high interest rates, 4.5%, 5% interest, a lot of that is taken out in fees. So I think innovation there is going to be using hedge equity, defined outcome funds for that bond percentage, for that bond portion, to give people lower vol that the insurance company can accept, but also a return pattern that the client and advisor can accept as well. And then one thing that I think is going to be out there, it's going to happen, there's already a filing for it, but I see a marriage between ETFs and insurance products where there will be an exchange-traded annuity. That will happen. There's the one that's out there right now, I think is overly complex, which scares me because, if something comes out that's overly complex, they'll kill it for everybody else. But I do feel that there will be a point where these two product lines are merged for ease of advisor and client use.
Well, great. How are we doing on time? We're good? So we're done?
No meeting. You can take some questions.
Great. All right. It's kind of hard to see. Anybody want to eat lunch, or you want to? Actually, I have a question. So with all the craziness going on this week with digital assets, is there a place have any of the ETFs in the crypto world taken hold in the annuity business?
I will. I'll just jump in here from very much from a broad standpoint. We have definitely, from a product construction standpoint, looked at the various different digital assets. We've looked at creating Bitcoin defined outcome or target outcome strategies that have and a limited upside. When I say limited upside, obviously we've seen the significant appreciation just this week with all of the cryptos out there. But I do believe, from that aspect, and again, the whole key in the, whether you look at it from a RILA standpoint or from a FIA standpoint, is you've got to be able to have the banks create some type of hedging profile for these type of offerings. But I truly believe that we're going to see crypto or digital assets, whether it's in the defined space, whether it's in the structured space, or whether it's in the insurance space, very sooner than later. Definitely, I would without question agree with that.
And I would say that the fact that these Bitcoin or currency type digital currencies are now in ETFs makes it much easier for the insurance company to include them. I don't think we would ever include like a pure Bitcoin type index, but I think we would look at a Bitcoin or a digital currency ETF.
And the only thing I would add to that is I would probably say, just thinking out loud, that probably it's going to be more on the shorter tenured space, whether it's a 3-month point-to-point offering, a 6-month point-to-point offering, or possibly a 1-year point-to-point. I just think with the huge amount of volatility, obviously from a hedging aspect, should allow you to have higher caps. But I think that from a hedging aspect, it's going to be more difficult for the longer tenured type of payoff profiles to be embraced in this space. But I do see it on the shorter tenured space without question.
Anybody? Oh, we did get, okay, it's gentleman in the back.
All right, I'll step forward to the shop. My clients see, variable annuities, variable universal life as a tax deferred structure to what they kind of already have in the traditional asset classes. Outside, oh, thank you. Outside, now they have the mic. Do you see any appetite for like a managed futures product, like a 3-vol, something with like a -50, -66 correlation to paper assets inside of an annuity wrapper? Any appetite for that?
We do, yeah. As a matter of fact, it's funny, we were looking at managed futures. There's very few VITs. So right now, it's hard to find a VIT that, like when I say VIT, to put it inside of an annuity, like a traditional variable annuity, it needs to be a variable insurance trust. But my hope is that as those are created, that we would like to include those. We're actually looking at a couple, but they're not yet at scale. But yeah, we would definitely like to see other alternative strategies as well. We have maybe in our annuities probably have 10 to 12 different alternative strategies. That's one that's missing and is needed.
I would just add to this too that there are some potential barriers there too from a concentration standpoint. Some of the regulatory aspects require that you can't domicile a limited amount of those strategies as like a single offering or whatnot. There are some concentration risk issues there, but I think if you can diversify it, it definitely can be embraced. I mean, we actually have a Dorsey Wright strategy as a VIT right now that is employing the underlying ETFs in this strategy. And again, Dell had referenced, kind of the 80-20 aspect where you've got, roughly 80% into equity with, 20% into some type of, investment grade fixed income. I do believe that if you can diversify it, whether it's managed futures or something like that, that it can be embraced as a VIT structure without question.
Anyone else?
Yeah, I have a question. So annuities are just, in my view, very complicated, and also it's very expensive. The fees are very high, and then for you to even add another complexity, which is making it a fixed index annuity, there's going to be more disclosures to relate to the client, and it's hard to explain what it does, adding another part to it. How do you make it look attractive for an investor to really get into it?
How do we make it more attractive?
Yeah, for a client to really be, motivated to get one.
I think part of what we've tried to do, and I think where the industry, as Jason had mentioned earlier, our industry does have a tendency to, we have something simple initially, and then we make it more and more complicated. We compete with each other on complex. We're not trying to, but we end up doing that. And I think that what you've seen over the last, I would say the last couple of years, on living benefits in particular, which are still expensive, but some of the simplicity has been added back into them. The complexity has been taken out of them. The value proposition has evened out. At one point, it was like all about, hey, the highest income at all cost. Now it's high income, but client flexibility back to an investment story, which is where they started and they got away from. So I think that the more that we do that in terms of kind of keeping, giving the advisor the investment story back is critical. Because what I've heard in talking to, we're starting to make inroads in the RIA channel. And what the RIA channel has told us loud and clear, and we've made changes because of this, is like, you know what, I like your value proposition on the income side. I'm not going to go through all that to get it. And so we've listened to that, and we've pared back, and I think the industry is. The expense issue, I think what you're going to end up seeing is probably two tiers of benefits. One that's, it might be a richer benefit, more expensive, and then one that's less rich but less expensive as well. But the important thing about doing that is we can't make them so different that we confuse it. It needs to be very simple. If you're gonna pay more, you're gonna get more income. If you're gonna pay less, you're gonna get less income, but that flexibility has to be consistent.
How about shorten the holding period of the annuity? Because the
Yeah.
client's locked in for like 5 or 6 years, and the fee goes down incrementally every year.
Yeah, we
How about
have
shortening that?
Yeah, we have now fee-based annuities that are RIA-based annuities for advisors. There's no surrender charge. There's no holding period. You can buy it and you can sell it whenever. Yep. And those are taking, yeah, you're right, those people are voting with their dollars, and that market is growing.
The other thing I would add too is I think that's why you've seen such a growth in the RILA space is again, the number one objective that you hear from a variable annuity standpoint is the fees, as you correctly brought up. But I think where you've seen the significant growth, and again, I've referenced, from 2017 forward, where we've seen this explosion from $7 or $8 billion in total sales to now probably approaching $60 billion in total sales just in the RILA space this year, is the RILA space, and the distributors specifically talk about that there are no explicit fees in this marketplace, and there aren't. You're passing through ultimately the cap and the buffer, whatever payoff profile, whatever tenor that you're looking for, with no fees attached. Now, granted, as you correctly stated, with these back-end surrender charges, you do have some interim values that you have with regard to the actual account value versus what the interim value is if you want to take some type of liquidity option from that, or some type of redemption option from that. But from a fee standpoint, the reason that, in my opinion, that the RILA has been so successful is there are no explicit fees in this space. We've made it a bit less transparent than the target outcome, option strategy that you put forward, where that is a simple, it's an option strategy that's creating that payoff profile. In the RILA space, you're making it a little bit less transparent, but there are no explicit fees that are involved in that. There are some options where you can pay for certain benefits to it, but there are no explicit fees.
So I was just given the hook. We got to go. Enjoy your lunch. Thank you, panel. Thank you, ETF Global.